It's pretty wild how a single government policy can send ripples all across the globe. But what happens when two of those massive events smash into each other at just the right time? Well, that's what we're looking at today. A kind of perfect storm brewing in global shipping, and India is right in the eye of it. So let's dive in. So, this really brings us to the big question, right? Can these two things, a huge push to build more stuff at home, happening at the exact same time a massive international trade deal gets signed, can that actually reshape how goods move around the planet? The analysis we're looking at says absolutely yes. And this right here, this is the main idea. The analysis calls it the Convergence Thesis, which sounds fancy, but it's really just that perfect storm concept we mentioned. So on one side, you get what's called a supply shock. That's India suddenly deciding, hey, we're going to build our own shipping containers. And on the other side, bam, a demand shock. A new trade deal that creates this instant, massive hunger for, you guessed it, shipping containers. The real genius here is how one move totally de-risks the other. Let's break down how that works. Okay, so first things first. To really get this, we need to understand the problem India is trying to fix. For a long, long time, it's been kind of a passive customer in global shipping, not a driver. And that quiet position, it's been costing its economy billions. Seriously. And this chart, wow, it just lays the problem out bare, doesn't it? India makes about 30,000 shipping containers a year. That's TEUs, or 20-foot equivalent units, just the standard box size. 30,000. Now hold that number because China pumps out 5 to 6 million of them every year. It's not even close. So what happens? India has to bring in about 2 million empty containers annually just to ship its own stuff out. That's a massive dependency. And yeah, that dependency isn't cheap. We're talking about a price tag of over 20,000 crore rupees. That's about 2.4 billion US dollars every single year. Just to rent empty metal boxes from other countries. That's a huge amount of money just flying out the door. So faced with that, how do you even begin to tackle a multi-billion-dollar problem? Well, that brings us right to the first major force in this perfect storm, the supply shock. This is India's big, bold answer to that problem. They're putting 10,000 crore rupees on the table for a massive plan to, you got it, build their own containers. But look, you can't just throw money at this and hope it works. For years, the big hurdle was that Indian-made containers were like 30 to 40% more expensive than Chinese ones. So this new policy attacks that problem head-on with a clever two-step approach. First, they're bringing down the cost of raw materials, like steel. Then, they're offering incentives based on how many containers you actually produce to close that final price gap. The whole point is to neutralize that China price advantage, making an Indian container just as cheap from day one. Okay, but think about it from a business perspective. Even if the costs are level, would you risk building a giant new factory? What if the demand isn't there? What if no one buys your shiny new containers? Well, this is where the government's plan gets really smart. They created what's called an anchor tenant, basically a guaranteed first customer. This new company, the Bharat Container Shipping Line, has promised to buy 1 million containers. Boom. Just like that, you have a massive built-in market. For an investor, that takes almost all the risk right off the table. And of course, making the boxes is only half the battle, right? You got to be able to move them around efficiently. That's another piece of the puzzle here. The 2026 budget is also firing up 20 new national waterways. Now, this might sound like a small detail, but it's huge. It means cheaper transport on rivers for both raw materials coming in and finished containers going out. It directly tackles that expensive first-mile logistics problem that's been a headache for Indian exporters forever. So let's recap. India is gearing up to produce 1 million brand new containers. The supply side is sorted, but the big question remains. Who's going to fill them? And that, my friends, brings us to the second and equally powerful force in our storm, the demand catalyst. This is where something happens on the world stage that changes, well, everything. 18%. Just remember that number, because it's an absolute game changer. After all the back and forth and trade tensions, India and the US finally hammered out a new deal. And the effect isn't years down the road. It's immediate. The main tariff rate for trade between them is plummeting to just 18%. And let me be clear, this isn't some vague promise for the future. The folks analyzing this are calling it an immediate catalyst. What that means is literally overnight, Indian products get a whole lot cheaper and more attractive for American buyers. That creates a sudden, massive demand for more shipping to get all those goods across the ocean. And there you have it. That's the convergence, the perfect storm. It's It's just perfect timing, isn't it? Right when India's getting ready to unleash a million new affordable containers onto the market, this huge trade deal kicks in and creates a tidal wave of new exports that need to be shipped. One side makes the boxes, the other side provides the stuff to put in the boxes. It's a perfect match.
Okay, so a supply shock meets a demand shock. That's great in theory, but what does it actually mean on the ground? Who wins? Let's take a look at the ripple effects and see who's set to benefit from this new landscape.
So, the analysis predicts this export boom is going to happen in two distinct waves. The first wave, hitting in the next 1 to 6 months, will be all about the quick-to-move industries. Think textiles, apparel, gems. Stuff that can ramp up production fast to take advantage of those new low tariffs. Then comes the second wave, over the next couple of years. That's when the heavier hitters, the more complex industries like pharma and auto parts, really get into the game. Now, if you're in the logistics business, this is where you should probably lean in. The analysis gets really specific here. The first thing you'll see is a huge demand for 40-foot high cube containers. Why? Because they're perfect for all that apparel and textile stuff, bulky but not super heavy. That demand is probably going to push up prices for secondhand containers too. And inventory is going to start moving a lot faster. Just to be crystal clear, this is all about container volume. We're not talking about oil tankers or energy shipping here. And this map really paints the picture. What you're seeing is the creation of a brand new strategic shipping lane. Containers are getting stacked up at key Indian ports. We're talking Mundra, Nevasheva, basically creating a direct pipeline straight to major hubs on the U.S. East and Gulf coasts, like New York, New Jersey, and Savannah. This is the new trade corridor everyone's going to be watching.
The money side of this is, well, it's just staggering. Remember that initial 10,000 crore rupee investment? That's about $1.2 billion US dollars. The projections show that could generate over $9.6 billion in economic value. That's an 8x return on investment. And the benefits are going to spread out everywhere. Port operators, the big global shipping lines, major Indian companies, and the entire rail and logistics network. Everyone gets a piece of the pie.
So, with all this happening, you have to ask, is India on the verge of becoming the next great maritime power? It's a huge question. Let's look at the grand vision here, and this is important, let's also ground ourselves with a crucial reality check. Yeah, this table really brings us back down to earth. Let's be real. Even if India hits its 1 million container target, China is still making over 5 million. China's grip on this market, like 95% of it, is just absolute. So the goal here isn't to knock China off the top spot. That's not realistic. The strategy is to become a strong, reliable number two, to be that China plus one choice for global companies that are trying to spread out their risk and not have all their eggs in one basket. And look, a plan this big is never a sure thing. There are definitely risks. The whole thing depends on everything running smoothly. You could have political squabbles slowing things down. You could have simple operational problems, like not having enough truck chassis to move containers off the docks, creating massive traffic jams. Even something as boring sounding as rules of origin could get complicated and make it harder for exporters to get those tariff benefits quickly. These are for sure the things we need to keep an eye on. But despite those risks, the long-term vision, the end game here, is crystal clear. This whole initiative is a major piece of India's Viksit Bharat vision, which is its big plan to be a fully developed nation by 2047. And the ultimate goal? It's to flip the script, to go from being a country that just imports logistics services to becoming a self-reliant, major hub that connects the entire global supply chain. So that's where we land. We've got this powerful collision of domestic ambition and global opportunity. India is absolutely charting a new bold course in maritime trade. The plan is massive, the timing feels almost perfect, but as always, the devil is in the details. Execution is everything. And it leaves us with one final big question. A new course has been set, but will the seas ahead be smooth sailing?